Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are talking about, give you my financial opinions. And, you know, it's June here in Colorado Springs. And yesterday we hit a high of 61 degrees Fahrenheit. And it is like in the 50s right now, 40s or 50s. It is cold, guys. This is supposed to be June. What happened? Anyway, let's dive into this. Again, if you want to follow me, you can follow me at finding_finance, or you can go to the website, sign up, use the word discount in the coupon code. We do have a question and answer session today at 5 p.m. Mountain Standard Time. You can ask me whatever questions you'd like. I can't give you financial advice, but I can give you my opinions around the market. You can see what companies I hold and all that stuff. It's all in the open. So I'm going to start off with the XAU to gold ratio. Miners ready to pop. I agree. I agree. And you know, it's kind of crazy. I'm surprised at how long this has lasted at this low point down here. It has been really cheap for a very long time. We came down in this level in the mid 2010s, and we're still down there, almost a 10-year basing period. And remember the saying, the longer the basing period, guys, the bigger the move to the upside when it does break out. It hasn't broken out yet. I've taken my positions in what I think are some of the most explosive companies, and also some good all-around risk-reward companies down at that bottom there. Some developers, some producers, and then some mutual funds and stuff like that. I'm pretty well balanced across the board, and even the physical metals. I'm doing it. I'm doing it all, guys. We just need one of these sectors to rip it, and I'll be sitting pretty. And it's like one of 6 or 7 sectors that I'm in. But right here, guys, this is an incredibly cheap level for the gold and silver mining companies at some point. Now, here there is a question that I do have. A lot of people are looking at this from the old paradigm. The old paradigm is 40-year decline in interest rates, stocks always go up, et cetera, et cetera, et cetera. There is a possibility that if oil gets really tight, that the mining companies may or may not do as well as we think. And it highly depends on the timing of some of this, as if the fear, so we could have oil go up in the beginning, this kind of lags like it has been lagging, and then people get afraid of the currency. And if people get afraid of the currency, we could see a large launch in gold, silver, and the monetary metals, and I'd say platinum's in there too. And then this would go ballistic as well. I do think that is inevitable at some point. I just don't know the timing of it. But I'm going to hang out in the things that are very tight in this world and that money has to flow to solve. And I think that precious metals is one thing that people will fear. They'll run to it in a fear game when inflation is out of control, potentially. And it's going to be a supply side driven inflation. That's my take on it. This person, they're stating high school sweethearts with good jobs, a baby on the way, and $600,000 budget can't find a house after 2 years of hunting. It is just so demoralizing, depressing, and defeating. And I did look into this a little bit. Looks like they live in a pretty high cost area location. And there just isn't really that many homes in that area that are less than $600,000. So I don't think that's, you know, a huge deal. You definitely could find a house in a bunch of different areas for $600,000. It just depends where you live and the location you want to be in. Angie G, she says, I don't care what anyone says. This is the amount I spent on charging my Tesla in 31 days. It's way less than gas. I agree. The cost to run an electric vehicle is definitely less than gasoline. I don't think there's any debate there. It's more efficient in terms of charging it and then using that electricity from the charge. So even if you drive the same amount of miles, it's going to be more efficient in an electric vehicle because the efficiency of storing and using that electricity, but it's not that much more efficient in terms of generating the fossil fuel. The fossil fuels generating that electricity and so forth. But where I get stuck, I have nothing against electric vehicles. I would definitely drive one if it were to fit within my original costs. The problem I have is if I go and I buy an electric vehicle, the original purchase price is expensive. And I'm cheap. I don't like putting up big ticket items right off the get go. I'd rather spend it on maintenance over a 10 or 20-year period than I would paying everything up front. If you pay everything up front, you pay, $40,000 to $70,000 or $80,000 on a car, which I just won't do. It's just way too costly. Then you've got your registration cost, you've got your insurance cost. All of those things go through the roof. The cars I own right now are liability only insurance. My insurance is a lot cheaper. My registration cost is like 60 something dollars a year. And my maintenance costs are super low because I do all the maintenance on the car. So if I end up spending, I get about 35, 36 miles per gallon on average on my car. And that's what I get on the other car, the Honda Civic as well. It's about that. We just don't spend that much in gas anyway. So even if I were to spend $100 a month versus 36, I don't really care. It's the registration costs alone are going to be $1,000 the first few times you have to do it. Like on average, the first few years will be $1,000. I don't even spend, that's like my entire fuel cost. So I just can't justify a daily driven car in Colorado that gets sandblasted, hailed on, and beaten by the sun to death, and justify spending all this money for a brand new car. I can't do it. I guess I'm just too cheap, and that's going to go. The only way that you can convince me is if I worked from home and the car stayed in the garage the majority of the time. Then I would consider, but even so, it's still too costly, and that's coming from a person who can easily afford one but doesn't want to afford one. And I'm a car guy. That's another thing. I'm a car guy. Coming on down, we've got American exceptionalism, healthcare. Something happened around 1980. It says life expectancy versus health expenditure. And we just took a right-hand turn in 1980. Right-hand turn. And we've been kind of deviating. I don't know what it is, guys. I go around and I see just random people, but a lot of people are a lot larger in the United States in terms of their BMI, the size of them. And I'm sure that has an impact with health expenditure and life expectancy. I also think that the foods that we eat are exposing a lot of genetic problems where if you ate healthier, those genetic problems or the genetic traits that person has, they may not be exposed. I'm talking about the telomeres on the ends of the chromosomes and stuff like that. So, wow, look at Japan. That's like vertical right there, guys. Japan and Switzerland. They live pretty old. But yeah, that's one thing I want to touch on. Maybe healthcare expenditure is a good spot to look for investment because as people do get older, their expenses go up and they spend more on healthcare, according to this graph here. And we're way out there. So the United States would be a good spot for healthcare and surgeries and replacement hips and knees and all sorts of stuff, which also uses more platinum. Some of that stuff does. So here's momentum structural analysis. This is Michael Oliver. He says, I wasn't aware that 5 months was forever. So far, at least, we're correctly called the top in the stock market in January 2022. And so far, we've been correct to be long-term bullish gold since February 2016. We're neither perma bull nor perma bear. And this is where I wanted to talk about is you can be bullish for 20 years and not be a perma bull. And I think, and I'm going to be kind of harsh here, guys. People are too stupid to know that you're in a bull market versus a bear market for that period of time. Like, they don't understand. So they're going to call you names. And that's like the worst thing, too, is to get called names. Why do you need to be labeled? What's with these labels that people put on people? I don't get it. But it says he's been calling gold forever to go higher and for the markets to decline forever, too. Yeah, but the process it takes is that long. Michael Oliver is right. You stay bearish when your momentum slows down. That's his game. What you're saying is, oh, he doesn't play the game right because the way that I think the game is played is my own thing that I think. So the people who play the game need to switch back and forth between bullish and bearish on short-term time frames. No, you don't have to be. What you need to be is what you need to be is whatever works for whatever time frames works for you. I am more in the camp of Michael Oliver than I am in the short-term camp. And when you start to see these things shift, these paradigm shifts occur in the market, what I do is I take the long-term approach, get long, stay long, and get in early when it's cheap. And then when I make millions and tens of millions or hundreds of millions of dollars, people are going to, tell me I'm wrong because I had to ride through 4, 5, 6, 50% pullbacks? Screw it. I don't care what they think. Go ahead. Post some crap on Twitter. Try to lure me in to be like, oh, you're wrong on the short term. I don't care, guys. It doesn't matter. And I don't think it matters even for him to be quote, wrong on a pullback that's temporary in the short term. And this is January 15th. He's probably looking at his indicators. This annual momentum chart argues don't trust any impressive rallies. The bear market's only in its initial phase of decline, which is true. I agree with this. Why do I agree with it? Because the market conditions can agree with it. The overall stock market has a high likelihood of rolling over. The breadth of the stock market is absolutely horrible. So a few stocks are going to hold this thing up, and we're going to go into what is called a bull trap. How bad is this person going to look if we get a bull trap and the thing just drops out from underneath at waterfall declines? And that's where I think people get separated. The younger, less experienced, and maybe it's not younger, just less experienced investor, what they do is they let price determine the narrative. They let price determine if they are a bull or a bear in the short term. And some of these guys is kind of the older individuals. They don't look at just price. They look past the price. The price is what gets you into trouble because all you're doing is you're just chasing price. You're letting price determine your ability, I don't know, your outlook on the market. And that is somewhat okay if you're a short-term trader, but if you've got a bigger picture view, you look at some of these billionaires, you know how they play it? They identify where the value is. They see that gap in valuation. They exploit the valuation gap and they hedge themselves with time. That's a Warren Buffett approach. And then they have people, oh, it's going to be bearish. It's going to go. You should sell all your stock. It's like, no, it's already cheap. I'll buy more if it gets cheaper. I'm not going to sit here and try to time the short-term little market movements. And then the guy makes, Buffett makes billions of dollars on his investments. And I know he's been underperforming the overall stock market because the guy's a freaking giant in terms of how much money he's got. He can only go into large cap stuff anymore. Otherwise, he basically buys out companies. But I don't know. I just wanted to talk about the short term versus long term and how I think Michael Oliver's killing it. But I think he does a really good job. And then we're back to Hubbard's peak and the Permian. And all I'm going to say about this peak stuff, guys, if that is here, if the peak is here, and we do peak out in shale oil, it's going to get real interesting. There's a lot of things that could change in the markets here. The paradigm of what the last 40 years looks like could be completely different than what the next 10 years looks like. We could see a good sized inflation because the supply side is going to start to basically drop off. And I don't know what that world looks like. I've feared that world since I was like 12 or 13 years old. Why that young? Well, when I was driving the car, I asked my dad when I was like 12 years old, I think. I said, Dad, how do we fill up all these cars? They're everywhere. We were on the highway, it was slow, and there was just cars everywhere. I'm like, how do all these cars, if they're like on average half a tank of gas or something, it's a lot of gas. Just what I can see when I was 12 years old, he's like, well, we got a lot of oil in the ground and we've got a lot to take out. And I was just like amazed because I see all these things, the airplanes flying around, and I saw all the cars, and I just couldn't imagine the hole in the ground that was being created with all these things that were burning gasoline basically nonstop, just in the area that I lived. And that's happening worldwide. So I just thought that was incredible. And I became fascinated with natural resources and investing in natural resources because natural resources are finite, a lot of it. And I think oil is probably finite. We're using it at a faster pace than it can regenerate. And even a lot of these other things, we can recycle them, but still, if more people are on the earth, that's more demand, and more demand equals, it equals higher prices of a commodity that's, I would say, stagnant. Stagnant, even though we may not know that some commodities on the earth, like we haven't discovered it or found it, it still means that it's stagnant on the earth. I mean, whatever's here is here. So, yeah, I just thought that was always interesting when I was a young kid. And that's kind of how I got into commodity investing. But anyway, guys, thumb up for the content, subscribe to the channel, subscribe to the website. And don't forget, we've got a 5 p.m. Mountain Standard Time question and answer session today if you want to join and be part of it. All right, guys, we'll catch you later. This is Finding Value.